Watch out for all the details coming up in just a bit. But it is the global setup that is the biggest headline this Wednesday morning. So let's take it up with Steve Bryce, Chief Investment Officer at Standard Chartered Wealth Management. Steve, thanks very much for taking this call. We were on a holiday here in Mumbai because of the Holi festival. Woken up to rather, somber news from the US Fed chair this morning. You tell us, my first simple question is, has the market in its knee-jerk move overnight, has it already priced much of the disappointment? If you're a bull, obviously it's a disappointment. Or is this going to be a start of repricing that will continue with maybe the 10-year moving higher, equities moving lower? How are you reading through this?
So I think the market's still digesting what Powell went through in his testimony yesterday. So I think there is still the near-term bias potentially for a 10-year yield, for instance, to move higher. Particularly the 2-year yield, looks to move higher as well. However, from a bigger picture perspective, we just think this doubles down on our view that ultimately the Fed will over-tighten. Actually, my personal feeling is that the Fed has already over-tightened. And if we were to stay here for long enough, that would induce a recession. So obviously, if they are doubling down on further rate hikes, potentially shifting to back to 50 basis points moves, then that would just mean that the over-tightening will become even greater. And that will lead to a recession. So, we still expect the curve to remain very significantly inverted, but the 2-year yield does seem to, be moving higher and likely to move higher in the short term.
So if you think the Fed has over-tightened already, what is your prognosis of what the March end Fed meeting could result in? I mean, there are talks that there could be a 50 basis points rate hike as well. Is that something that you're not expecting? And what do you see as the move on global equity markets now?
Look, I guess on your first question, I think the Fed's in a really difficult situation. Let's not make it easier than it is, right? I mean, if you've got very strong growth data out there at the moment, inflation is looking particularly sticky. Then it is very difficult for it to sort of look through the cycle and say, probabilistically we've over-tightened. Their number one concern at this stage is to bring inflation lower, and any weakness it generates on that side or signals on that side, then that could make its job a lot harder further down the road. So, I think 50 basis points, depending on obviously the inflation report and the unemployment report due before the Fed FOMC meeting, is a definite possibility. What does this mean for equity markets? Well, obviously, we've seen the knee-jerk lower overnight. I mean, from our perspective, higher rates is obviously something that markets struggle with, particularly in the US market, because it's a heavy weight towards tech. So that is an environment that is pretty challenging. But our biggest concern is saying, it is for another third leg lower for US equities actually comes from that recession risk. So if we do see a recession before the end of this year, then we are likely pricing in stronger earnings than we're likely to see going forward, and we could see that third leg coming lower to the US stock market, potentially testing lows of last year and maybe even making new lows. So that's the bigger risk we feel for the US market rather than the rates outlook in the short term.
All right. Hi, Steve. Morning. In a month or so, how things changed, right? I remember when we were chatting the last time, maybe you were hinting even at some rate cuts towards the end of the year. You believe post this commentary that we're getting, that's out of the window?
I don't think it is. I mean, it's obviously harder to make that call today than it was a month ago. But I don't think it is, because once the recession becomes clear, then the Fed is going to be faced with the situation of saying, OK, yes, inflation is above my target, but how much higher am I willing to push the unemployment rate? We know that monetary policy acts with a very significant lag. So, if we were in recession by the end of this year, there'd still be further tightening down the pipes coming from financial conditions, generally speaking. And from that perspective, then the Fed, do they really sort of hold stance and leave interest rates where they are as the economy starts to go into a recession? It's going to be a difficult situation when we get there, because inflation won't be at 2% or lower. It will be probably, at least above 3%, maybe even above 4% by the time that happens. So they will probably ease reluctantly, but I think we still will see easing by before the end of the year.
Okay. All right, so there's still an outside chance that we get some rate cuts towards the end of the year. So that's pretty good news. But Steve, let's talk about our Indian markets. You know, you were tilting towards China. One of the factors that was plaguing Indian markets a month or so ago was the Adani Group. They were in a bit of a tizzy, but now there is some clarity emerging out there. They managed to raise some money, releasing pledge. Some confidence is back into the system. Will you still drift towards China in comparison to India? Or do you believe post this recent underperformance of India, we're fairly well placed now?
So, I mean, we were never bearish on India, right? So let's put it in context. So we're overweight Asia ex-Japan at the sort of level 2 regional level of equities. And within that, we're neutral India. So we'd expect, for instance, India to outperform the US stock market over the course of the rest of the year. We still have a tilt towards China. Obviously, China's going through a repricing in very recent past as well. In terms of, you know, there's some concerns on the geopolitical side, obviously playing out, and you know, not everything's been swimmingly positive. But ultimately, we think that the price differential, or valuation differential, obviously is very much in favor of China stocks, and we see that impetus in growth coming through as well, as China obviously targeting over 5%. We'll think they'll beat that quite convincingly this year. So from that perspective, we still feel that China is likely to outperform, but that doesn't mean that India can't do very well this year and probably outperform even what it did last year when we were overweight in obviously a falling environment.
You know, Steve, I just want to kind of probe a little deeper on that analysis. Of course, it sounds fantastic to us sitting here that you are expecting India, despite whatever's happening with the Fed, to actually outperform at least the US market. In history, it's kind of been a little different, right? Every time the mother market goes into any sort of a slump, whether it was the global financial crisis or, you know, several other crises before that, emerging markets also end up underperforming. So what makes you confident that this time it's going to be different and India can actually outperform the US market irrespective of this recession and the impact it's having there?
Yeah, I think it comes down to that the dollar is obviously an important piece here. I mean, the way I sort of look at this, I mean, and more probably from a China perspective than an India perspective, but you know, I see this as a mini 2008-2009 cycle, where the US heads into recession, but China is on a different path. Obviously, then it massively stimulates, some would argue, overstimulates the economy and creates some of the debt challenges we're still faced with today. But I think we don't see the US recession being anything like as severe as the global financial crisis. But we don't also see China stimulating to the same extent, but obviously on a different path. From an India perspective, I think the key thing is that dollar. So if we see the dollar peaking out probably on that growth differential or different projectiles for Asian growth versus US growth, we think that should be quite positive from a Indian market perspective. And obviously, if we do see the US go into recession, then that should cap any increase in oil prices as well, which should be positive for the Indian economy and also the stock market.
All right, Steve, we will leave it at that. Thanks a lot for joining in and speaking to CNBC TV 18. So that's the word coming in on the global market. Steve Bryce saying that they expect the Indian markets to outperform the US for the rest of the year. He doesn't rule out the possibility of the US markets getting back to their lows that they saw last year sometime through the course of 2023. All right, let's slip into a quick break. On the other side, we'll get you our list of top 10 stocks as we kickstart a brand new day of trade. Stay tuned.